Hey YouTube, it's Matt Decker with Leveraged Wealth Management and Cash Value Life Insurance Reviews. Today, I'm going to do a quick video on showing you the effect of 0 years on your indexed universal life insurance policy. You should expect a 0, let's say 3 out of every 10 years. But what I really want to do in this video is focus on how those 0 years impact a policy when it's structured the right way versus how they impact a policy when it's structured the wrong way. Let's start with the right way. We're looking at a policy structured the right way for a 48-year-old male, standard non-tobacco. Now we're putting in $50,000 a year, and we're going to do that for 16 years, and then we're going to use this policy as lifetime income starting at age 65. Now, when I say that this policy is done the right way, what that means is that we've got the minimum death benefit here that the IRS is going to allow, and we're using a good death benefit option that reduces fees and commissions. In this particular example, we're just looking at something that you've probably seen if you've ever looked at an index universal life insurance policy before, and that is just a flat level return. So in this case, it's 6.64% in all years. Every single year, 6.64%. Now, it's structured the right way, but you and I both know you're never going to get 6.64% on the nose every single year. These policies just don't work that way. But let's take a look at the income that we're projecting here at the levelized 6.64%, and we're looking at $138,000 every single year, tax-free for life, structured the right way starting at age 65, based on a 6.64% rate of return. Now, what I'm going to do here is I'm actually going to show you how this policy would perform if instead of showing 6.64% in every single year, what I'm actually going to do, I'm going to throw in 11 years of 0%, and everything else is going to be 6.64%. So what that's going to do is it's going to throw in those 0 years where you get no credit and yet the fees still come out of the policy, and it's going to reduce this overall average rate of return because I'm not showing a higher rate of return in the years where we're showing credits. I'm simply throwing in 11 zeros. Okay, so the years where we're going to show a 0% rate of return are in the first 5 years. We're going to show 5 straight years of 0, and then we're going to show 6 years of 0 starting in year 10 through year 15. So those are going to be our 0 years right there. So before you start income, you're only going to have 4 or 5 years of actual policy performance. And again, the goal is to see how those 0 years affect our income stream. So let's take a look at that. Okay, so this is our policy that is exactly the same. It's the same 48-year-old male. It's the same death benefit option, exact same premium. But check out the interest credited column here. We basically have no credits for the first 5 years, 0.01%, and then we have no credits for these 6 years here. Now, there is a bonus on this product, which is why you see some ancillary interest here in these years. But look at the difference between year 16 and 15, 63,000 in credits versus 7,000. So our 0 years are in there. And let's take a look at how this is actually going to impact the income on this particular policy. Now, you should expect it to be lower. Of course you should, because we're throwing in 11 zeros. And here it is, $85,000. So if you throw in 11 zeros in the first 18 policy years, your income is reduced drastically, as you should expect that it would be. We're showing a lower rate of return, so of course your income is going to be less. But how much less as a percentage of the initial amount? Well, if you remember, we were showing $138,000 per year. Now we're only showing $85,000 per year. So what percent is that of the original number? Well, it's right at 61% of our original number, which on the face of it doesn't sound all that good. But if you take a step back and you think about 11 0 years in the first really 16 policy years, that's only happened one other time. It's only been close to that one other time, and that was actually during the Great Depression. So this is an extremely safe projection 61% of the original income if you throw in zeros. And keep in mind, we're not increasing the rate that is credited in those off years, which more than likely, if you have a bunch of 0 years in here, you're gonna have some years where the policy caps out. We're not showing that. We're showing years of 0% followed by 6.64%. We're not showing years of 0 followed by a couple tens. So this is extremely safe the way that we're projecting this out. And if you were to get a policy that had tons of 0 years, it's not going to look like this, because you're going to have years where you get a 10% rate of return, years where you get a 2% rate of return. It's going to be all over the place. So the exact percentage here is not what I want you to key in on. What I want you to key in on is the difference between how this looks. You projected 138, but when you throw in the zeros, you only got 85 for 61% of your initial income. Okay, so this is the number I want you to key in on. 61% of your initial income once you throw in 11 zeros. Because what I'm going to show you next is a policy that is not structured the right way. And we're going to do the exact same thing and see what percentage of our initial income we can get if we have a policy that's structured the wrong way. So let's take a look at that. So what you're looking at here is a Pac Life policy that is really structured extremely poorly. It is structured so that the broker can make maximum commissions. And how do you know that? Well, you know that because they're using a bad death benefit option, and the death benefit is way up there. Whenever you see a huge death benefit like this, using the exact same premium, you know that more commissions are involved. But again, it's the same 48-year-old male standard non-smoker. And you can tell that we've really increased the fees on this policy, because look at our starting income. It goes from $138 all the way down to $73,000 for life. So right off the bat, you can see the impact of a poorly structured policy. $73,000 versus $138,000. And this is actually showing a higher annual credit, 7.1%. all years, 7.1% all years. Structured poorly, we get $73,000 a year versus $138,000. But that's not the point of this video. The point of this video is not structuring it right versus structuring it wrong. The point is what happens when you get 0 years on a poorly structured policy. So we already knew that this income was going to be lower. That's a given. It's a poorly structured policy. But check out what happens when you throw in some zeros. So this is our Pac Life policy where we've thrown in the zeros, and I just want to show that to you first. So here's our 0.1% years 1 through 5. That's the same. And then again, 0% years 10 through 15. That's the same. So we're using the exact same 0 years in this Pac Life policy. Again, it's structured poorly, but check this out. Our income goes from $75,000 a year all the way down to $17,715 per year when we throw in those zeros. Now again, the overall number is not necessarily what I want you to key in on. What I want you to key in on is the percentage of the original amount. So we were looking at 73,539, 73,539 compared to 17,715. We're looking at 24% of our original income projection. 24% of our original income projection in a poorly structured policy when we throw in some zeros. 24% of our original projected income versus 61% of our original projected income. So I hope that just goes to show you that it is critically important that you have a properly structured policy. Why? Because there are going to be years where you do not get a return. That's just a fact of life. And if you have a policy that's structured the right way, it's going to be able to withstand those 0% years. If you have a policy that is not structured the right way, it is going to crumble and crumble quickly. Now, if you have an Index Universal Life Insurance contract, or you're thinking about getting an Index Universal Life Insurance contract, number one, if you have one, I would encourage you strongly to get an Index Universal Life policy review. And if you want an IUL review, I can do that for you. What you need to do is go to the link in the description below this video. I will also pin a comment. It's leveragedwm.com/IUL-review. and I will do a policy review for you, and we can stress test your policy and make sure that it's done the right way. And if it's not done the right way, we can look at some options on how to improve upon it. If you don't have an index universal life insurance contract, but it's something that you've been considering and you want my opinion and you want my help, you think my videos are helpful, I'd love to work with you. You need to go to the same place, leveragewm.com/IUL-review. Again, that link is going to be in the description below this video. I will also pin a comment. You can go there. You can reach me that way. This has been Matt Decker with Leverage Wealth Management and Cash Value Life Insurance Reviews on YouTube. Thanks so much for joining me. I hope that you found this helpful. We'll talk to you soon.